Okay, so good morning, everyone. Can you hear me? Okay, good morning, everyone. First of all, welcome all of you to join our past seminar today. My name is Chang Wu, and I am a professor and co-director for CCF Center at School of Accounting and Finance at Hong Kong Polytechnic University. As you might know, CCF is the first ESG and sustainability educational center in Hong Kong. We want to promote ESG and the sustainable economy through academic research, education, and knowledge sharing with our industrial partners. So with the support of Hong Kong government, CCF is organizing a series of seminars called PASS Seminar. Today is the 9th seminar, and the topic is ESG and rating optimization. So we are so delighted to have 3 wonderful speakers, both from academic and from the financial industries, to give us our updates and their thoughts and insights on this topic. So now I would like to first introduce our academic speaker, Dr. Mo Han. Dr. Han is research assistant professor at Hong Kong PolyU, and Dr. Han received her PhD in finance from University of Texas at Dallas. Her research interests include mutual funds, other institutional investors, and environmental finance. Her research has been awarded the Outstanding Paper Award in Investment at the Eastern Financial Association. Dr. Han is going to talk about how using the ESG data for ESG investment. Okay, so without further ado, I would like to invite Dr. Han to give her research update. So if anyone has questions, you can type in the chat room, right? Is that right? So we will answer the questions at the end, okay?
Okay, thank you for the introduction. I'm very honored to make a presentation at the seminar today. My name is Moonhee Han, and I'm a research assistant professor in finance at Hong Kong Polytechnic University. Today, I'm going to talk about academic perspective on ESG investing and more about ESG data and rating. So this is outline for today's presentation. So first of all, I'm going to talk about background of ESG investing, such as recent trend and also some academic findings in written predictability of ESG characteristic. And also we're going to go back to a little bit to some basic stuff, which is about what the ESG data is, and also ESG rating provider, or we call the ESG rating agencies. And last one is the divergence of ESG rating from the more academic perspective. So recently, there has been a rapidly increasing appetite for environmental, social, and governance investing. So ESG investing has evolved in recent years to meet the demands of institutional investor and retail investor, and as well as certain public sector as well. In this respect, investment company has come to start considering ESG as an investment strategy. According to the report by Global Sustainable Investment Alliance, global sustainable investment reached $35.3 trillion in 5 major markets. So a 15% increase in the past 2 years from 2018 to 2020, and also 55% increase in the past 4 years from 2016 to 2020. Moreover, COVID-19 pandemic has been accelerating this trend. And as we can see this figure, even though it's a little bit small, this figure shows that proportion of sustainable investing relative to total managed asset. So as we can see, some country, like especially this proportion of sustainable investing to total managed asset has been increasing in United States and Canada and Japan. But as we can see, some other trend line in like New Zealand, Australia, and Europe has been decreasing. It's a little bit different. But even though the trend is a little bit different, the reason why we can see this decreasing trend in these 2 territories is that they have changed their requirement for the reporting, is reporting or the definition in sustainable investment. So the importance of the ESG investing in these 2 countries are still very important. So we can emphasize that the importance of the ESG investing has been still very increasing over the world. And moreover, I borrowed this graph from the PRI website. The PRI is the world leading proponent of the responsible investment. So similarly from the previous slide, the number of this yellow line is showing that the number of the signatories, which is the institutional investors committed to ESG-oriented investment decision. So as we can see, this yellow line has been increasing over the time. This means that the number of the signatories are more making a ESG-oriented investment decision has been increasing over the time. So more specifically, if we look at the graph from 2010 to 2021, this number of the signatory has increased from about 700 to more than 3,500. So this graph also describes how the market has been more demanded for sustainable investment. So what about individual investor? So when it comes to individual investor, this graph is, I also borrowed the picture from the Hartman and Sussman 2019 paper, but even though this graph is not in the paper, I borrowed this graph from their slide. They have changed a little bit the graph in their paper, published paper, but the actual implication is the same. So after the publication of the sustainable rating from the Morningstar in March 2016, the flow of to the high ESG profile mutual fund and the low ESG profile mutual fund has a little bit different. I mean, this graph the paper suggests that sustainable investing is growing very fast, and mutual fund that invest according to the ESG rating experience large inflow. So this implies that the institutional investor also had focused on ESG investing in around this ESG rating in the last time over the few years. And moreover, from the practitioner report, like according to the report by Morningstar, the fourth quarter 2021, assets in sustainable fund hit a record high, about $1.258 billion as of the end of the September 2020. And global sustainable fund assets expanded by 9% in the fourth quarter to $2.74 trillion at the end of the December 2021. And moreover, investors' interest in ESG issue has been driving the increase in inflow. The sustainable fund, there was a 12% increase relative to the third quarter 2021. And as we can see this table, this first two columns shows that the sustainable fund flow to the sustainable fund from quarter 3 and quarter 4, and this second part is about conventional fund. As we can easily find that the inflow to the sustainable fund has been increasing from quarter 3 to quarter 4. But as you can see that when it comes to conventional fund, it has been decreasing. So we can recognize that the institutional investor also has focused on ESG investing in their area. And as I mentioned, the COVID-19 also has been accelerating this trend over the last 2 years. So the COVID-19 has increased institutional investor focus on ESG. So I borrowed this picture from the one report, which is written by FTI consulting report. The title is "How Has COVID-19 Changed Institutional Investors' Approach to ESG?" So in this report, they use based on this report is based on the survey result. So basically they do like in August 2020, they contacted 267 global institutional investors representing more than $10 trillion asset under management, comparing the response against a similar group surveyed by the right before the pandemic in February 2020. So as we can see this graph, institutional investors are considering a positive correlation between the strong ESG performance and high company ESG performance and high company valuation. Because as you can see here, the x-axis is the percentage increase in corporate value, and y-axis is the percentage of the the number of institutional investor. So there is some positive correlation between this value and high profile. So, and according to the data, the a total of 99% of the respondents said that high ESG rating would increase its corporate value but at the same time, only 35% said that a high ESG rating would increase corporate value by only 40%. But still, the average auditioner value for a company with a high ESG profile rose by 2.1% from 61% to 38.2%. This means that this finding shows that these global institutional investors are more taking some sophisticated approaches to ESG over the pandemic. And also this chart shows that the survey result. So basically how strongly the respondents, like here, the global institutional investor, like the institutional investors participate this survey, agree or disagree with several statements related to the ESG policy at the firm level. So these metrics are also used by many ESG rating agency or rating provider. So based on the result, investors are also looking for greater transparency and accountability from ESG reporting over the pandemic. So based on that, we recognize that many institutional investor and individual investor also in other firms are also has focused on ESG investing. So could we expect any like superior passive returns from sustainable investment? According to the survey by BlackRock 2020 and BNP Paribas 2019, maybe investors often say yes. And also asset managers often say yes. For instance, BlackRock, they said that integrating sustainability can help investors build more resilient portfolios and achieve better long-term risk-adjusted returns. So we can easily think that ESG might add value to firms, which means that firms with a higher ESG profile may attract more on higher paying customers and may attract shareholders who want to care more about social issues, and it may decrease firm risk. But at the same time, there are opposite views as well. So here I'm going to introduce some academic findings about the return predictability of ESG characteristics. Economic theory generally argues that high ESG firms should have lower expected returns as socially oriented investors require less compensation for holding high ESG funds. So generally, we have many documents to show evidence on this in our literature. Like there's some paper find that there are some return predictability of ESG characteristics, but at the same time, we have also several papers, including Hartman and Sussman 2019, who document no effect on return predictability of ESG characteristics. So there is some mixed evidence on this return predictability of ESG characteristics based on the previous literature. And also, especially Pastor, Stembo, and Taylor JFE 2021 paper, they find that sustainable investment had lower expected returns since investors like holding sustainable investment, like a green asset usually is a high price, so we expect that there is a low expected return, but it's like holding the opposite. And also they can offer a hedge against climate risk. So therefore, based on this theoretical model in their paper, they find that investors may have lower expected return, sustainable investment may have lower expected return. So along with this growing interest from investors, there are some new requirement for reporting has been evolved. So in Europe, the Sustainable Finance Disclosure Regulation, which is called SFDR, is a set of EU rules which aim to make the sustainable profile of funds more comparable and better understood by an investor. And also in the US, the SEC has been considering to propose mandatory ESG disclosure requirement. I believe that it's going to be happening in this year based on their article. There is a growing evidence that investors and financial intermediaries are increasing factoring ESG assessment into investment decisions. So there has been growing influence of ESG data and ratings, which is very important nowadays. Therefore, the importance of the quality of well-structured ESG data and ratings have been important, right? But so we're going to go back to basic steps. So I think that many of you guys already know what the ESG data is and what kind of information the data has, but we're going to look at this basic stuff again. So basically, let's say like ESG, so environmental, social, and governance data. So we can when it comes to environment aspect, we can get the information from the from the company's level, like climate crisis, carbon emissions, water efficiency, or renewable energy. And in terms of the social aspect, well, the company can provide us some information about the equal opportunity in terms of the hiring process or human rights, and child labor. And also when it comes to governance aspect, the company also discloses some business ethics and board independence and shareholder democracy. This all kind of information at the data is available for the ES data. So how the data is collected? So actually we can categorize at the fund level or the government and public. So basically we are more focusing on funds from level because our research area is more accounting and finance, so we are more focusing on fund level. So basically the company can disclose their ESG report on their website. So we can easily, some cases we can easily find it, especially public funds. And also nowadays there is some database which includes all the ESG report at the fund level. So, but problem is that nowadays still is not mandatory. So it is a self-reported ESG information at the fund level. And also the government and NGO, and they also disclose their information about on the website and their report on the website. And also in the public side, we can find the information from the news article or social media and company reviews. So here I take one example, some example about the ESG report, so Apple and Starbucks. For instance, if we look at the Apple ESG report, we can find the green bond and some how their operation and how they changed their design, to recycle some contents in their compared to the previous year. And in the Starbucks, they only disclose their business ethics or the plant the coffee, but the problem is that I recognize that there are concerns about their data quality. For instance, when a company is self-reporting, inherently there could be some bias. I mean, there could be some good thing is that there could be some freedom, and also company can report what they want to disclose, so we can easily find much information from the company level. The problem is that there is no standard and there is no form, so the quality could be varying a lot across the data sources. Okay, so let's look at some ESG rating provider. Also, we can call ESG rating agencies. So ESG rating provider basically defined as organization that investigate firms' environmental, social, and corporate governance policy to determine its sustainability. Given growing importance of ESG data and rating, they're having a growing number of players. But at the same time, there are several key players. I think only like 7 or 8 large players play key roles in a market. So for instance, I provided some cases. They're like acquisition cases. So for instance, MSCI acquired the GMI rating in 2014 and Carbon Delta in 2019. And also Moody's acquired the BDO Aries in 2019, and S&P acquired Truecoats in 2016, and ESG rating business of the Robeco Sam in 2019. So I think in at least 4 or 5 years ago, there are more players, not big guys, but nowadays many large players, including credit rating company, also become a key players in ESG rating, in ESG data provider, as a data provider. So here I summarize one table to show what which players are mainly working in this area, this industry. So but Morningstar actually acquired Sustainalytics. So, but this is very recently. So as we can see, there are one like 10 key players, and as you can see, the coverage is a little bit different, and also score mechanism is also different, and rating cycles are also different, and some sources are also different. The good thing is that there are a variety of the information, various information across the different the rating data provider. But later I'm going to point out maybe it can cause some problem or some issue in academic research or even making policy at the fund level. And this chart one is showing that number of ES rating and data providers used by the largest 50 asset managers. So among the 50 asset managers, the 20 asset managers are using more than 4 ES rating and ES data provider. This means that they are more considering the different data provider, ES rating and ES data provider in order to form their portfolio and make an investment decision. So I bring the same figure to show how institutional investors are how mutual fund inflow can be affected by this ESG different ESG profile. So after the publication of the star rating related to the sustainability, the inflow to the mutual fund with a high ESG profile has been increasing compared to the low ESG profile. So this implies that the institutional investors still the ESG rating is very important for this investment decision making. But we know now the importance of the ES rating and ES data provider has been crucial, but at the same time, there could be some problem. In the past 2 years, US firms in the financial service sector have spent more than $3.5 billion buying green rating firms and data provider, just buying the firms and provider. In many cases, firms that rate or evaluate companies based on issues such as climate risk also sell service to help companies to address this issue. So like the credit rating industry, there can be potential conflict of interest. So I borrowed some idea from this article from the Wall Street Journal and also the ESG Mirage from Bloomberg article. So more specifically, Morningstar only gives out performance awards that are available for only to companies that pay for an ESG assessment. And also credit rating firms like Moody's or S&P sells ESG service create a further set of the potential conflict. I mean, credit rating agencies are more likely to be reluctant to downgrade companies that pay them big fees because they care their clients. And also, according to the ESG Mirage article from the Bloomberg, MSCI have upgraded many company, like about the 100 company out of in a S&P 500 list without any specific changes. So there could be some conflict of interest between the firm and also their client and also the ES rating provider. Also, there is a growing number of academic studies that rely on ES ratings. And recently, there are many papers are focusing on the ES rating. For instance, Flamer 2021, the paper published in JFE, they examine corporate green bonds, and they find that green bond issuers improve their environmental performance post-issuance, an increase in the firm's ES rating. And also another paper recently published in JFE, and the Aravov and his co-author analyzed the asset pricing and portfolio implication of important barrier to sustainable investing. So basically, they use ESG rating as a proxy of the uncertainty, and they use 6 different ESG rating provider as a proxy for ESG uncertainty. And then they provide supporting evidence for their model prediction. So let's talk about divergence of ESG rating. So I mainly focus on one paper, Berg and his co-author, 2022, and this paper was this paper. Of course, before this paper, there are some papers point out divergence of the some ESG or CSR rating. But this paper is trying to quantify all the ESG rating from the different ESG rating providers. So this is a very important paper that is talking about divergence of ESG rating. So they document the rating divergence of ESG based on 6 key ESG rating agencies, including KLD, Sustainalytics, and Moody's, and S&P, and Refinitiv, and MSCI. But as we can see, the correlation metrics, there is, if we just think about the correlation between the credit rating across the different credit rating agency is more than 90%. But as you can see, this correlation metrics, some cases are either like a 70% or 60%, but some cases even minus or very low correlation across the different ES rating provider. So before this paper, also there are several papers point out some divergence of ES rating. So I'm gonna briefly introduce those papers. So Chatterjee and his course 2016, this paper was published in an SMJ. Actually, they had focused on CSR rating rather than ESG rating, but still they point out the very important part about the divergence of the ESG rating. Basically, they provided 2 reasons for the divergence across this CSR rating in their paper, how the raters define what they intended to measure and whether it is measured reliably. And also Christian and his co-author 2021 that published, I think, TAR, the accounting review, and they examine whether a firm's ESG disclosure helps explain disagreement from ESG rating. They want to see if this disagreement of the ESG rating can have an impact on so they want to know whether this ESG disclosure can resolve the problem with a disagreement from the ESG rating. But interestingly, they find that ESG disclosure generally exaggerate ESG rating disagreement instead of resolving it. And Brandon and his co-author 2021, they has asked a fundamental question about whether ESG rating disagreement affect stock returns. And then what they find in their paper is that stock returns are positively related to ESG rating disagreement. So those papers are about the divergence of ESG rating, but they asked another question related to divergence of ESG rating. But in this paper, they are mainly focusing on which factor can drive the divergence of ESG rating, and they were trying to quantify this from the different data sources. So basically, the authors argue that there are 3 distinct sources of divergence. The first one is scope divergence, and second is a measurement divergence, and third is weight divergence. So they categorize 709 indicators provided by the different data provider into a common taxonomy of 64 categories, which is a very important thing because they integrate all the data information from the different data provider and then make some common part of the 64 categories. And then what they find in the paper is that measurement divergence is the main driver of ESG rating divergence. So furthermore, their findings show that the disagreement of ESG rating is mainly driven by a fundamental disagreement about the underlying data rather than a matter of varying definition. So they mainly, the reason why we can see the divergence of the ES rating is that the fundamental disagreement is that the underlying data could be main problem. So until now, we point out that ES rating from different provider significantly disagree. So we know that. But why it is important? Why we need to care about that? Basically, this disagreement has important consequences. First of all, if we have a different data, if there is some divergence of ES rating, it is hard to evaluate the ESG performance of the fund level or even fund level and portfolio level. And ESG rating divergence also can discourage from improving their ESG performance. So like there could be some mixed signal from rating agencies, because as I show the correlation metrics, some cases, the correlation across the different data provider, ESG rating provider is very low. So that means that even if the same fund or same portfolio, we're going to see different score from the different data provider. So there could be some mixed signal from rating agency at the fund level. For instance, there is no incentive to make investment in certain sustainable investment, so it's going to lead to the underinvestment. And finally, from the academic perspective, the divergence of ratings poses a challenge for empirical research, as using one rater versus another may alter a study's result and conclusion. So, but even though I have focused on divergence of ESG rating from this academic paper, but some researchers point out that what we need to focus on this divergence of ES rating. I mean, why do we need to see the high correlation across the different data provider? Because even though I mentioned that the credit rating agency, credit ratings tend to have high correlation, about more than 90% across the different credit rating agency, it's a little bit different. I mean, ES rating are different from the credit rating. So we don't need to see only high correlation of the ES rating across a different provider. If we have multiple data sources and various data sources from the different data provider, we can use the different, we can pick, or we can choose the factor that we want to analyze for our research agenda. So we don't need to focus on this diverse ES rating as well. But so, as I mentioned, there are some different opinion about this divergence of ES rating. So some people think that divergence of ES rating can cause some problem in terms of the some research question or making a good policy at the level. But at the same time, the using the different data sources can make a more freedom to think about the more research agenda. Okay. That is all I have today. Thank you for your attention. Any question and any comments?
Thank you. Thank Dr. Han. Very, very informative, a very comprehensive introduction of all different data sources for our ESG rating and our research. So it's very helpful. So next, I would like to invite Dr. Ledman Nee, Professor of Practice at PolyU, to introduce our industrial speakers and host the remaining talks and discussions. So the floor is yours, Dr. Nee.
Thanks, Professor Chang, and thanks, Dr. Han, for the insightful share. I think you touched on a number of very interesting topics, all the way from ESG rating divergence, the investment management process using ESG ratings, and some of the strengths and weaknesses and the conflict of interest. I'm sure our guest speakers will be also touching upon that, and I will see you back at the panel, Dr. Han. So maybe let me quickly introduce our speakers. Right now we have Gabriel Wilson Otto. We have done panels before. Gabriel is a director in sustainable investing at Fidelity International. Before that, he worked at BNP Paribas as the global head of sustainability research. He has experience with Deutsche Bank, Goldman Sachs, and in our prior dialogue, actually, I know that Gabriel has worked with many different rating agencies, knows the strengths and weaknesses of all of those. So really welcome, Gabriel. So we look forward to your sharing in the coming 20 minutes or so around how to leverage ESG data and ratings in the investment management process, and more specifically from an investment manager's perspective. Obviously, I know you have tons of insights around ESG ratings, but I think we can leave that for the panel. And for the broader audience, if you have any questions, let's leave that for the panel discussion and for the Q&A. Because if you type it right now, we might miss it out. So do have them at hand. So really, Gabriel, really the floor is yours. Really, thanks for taking time to do the sharing with us. We have today more than 200 participants, which is great. We're really looking forward to your sharing and our panel discussion, Gabriel.
Cheers. Thanks a lot. And thanks a lot for having me here and for the opportunity to present on the topic. I was definitely nodding along through the last presentation. All of the issues that were raised are definitely issues that we're struggling with in the industry. The divergence of ESG ratings, for me, is a really, really interesting topic that you could run into entire course on in the individual granularity of different ratings approaches, the impact it can have, but we'll get into that a little bit later. What I wanted to do is, I'll share a slide deck shortly, but what I want to cover in this is essentially to try and highlight how this information is used and the importance of understanding how a rating has been created so that you're using the right tool for the right purpose when you are actually integrating this into an investment process, product design, product selection, any of these sorts of use cases. We need to make sure that we have the right tool for the right job. And this is actually one of the reasons why most asset managers that are large global managers are starting to build their own ESG ratings, because they've found that what currently exists in the market actually has specific biases, specific challenges when applied in a certain way with a certain investment philosophy or approach. And so it may not always be fit for purpose. And some of the biggest examples here are that we have ESG ratings which are absolute measures of risk versus ESG ratings which are sector relative measures of risk. So if you're depending on your portfolio, depending on your investment objective, one might be appropriate, the other one might be appropriate. And so it really is just about trying to understand exactly what you're trying to achieve and the best way of really drilling down on all of this. So that's enough of an introduction. I'll see if I can get the technology to work, which is always a question mark.
And I think, and others, please put yourself on mute if you are not speaking to not interrupt our speakers.
Great. So as we were kindly introduced, today I'm going to be presenting on how ESG data can be used in an investment process and also product creation. And I'll use some of the data that was provided in the earlier presentation. We use the same sources, which is always encouraging to find that the academic and technical experts on this are using the same data sets. But what I wanted to highlight is that one thing to really take into mind here is that the change in ESG, in focus on ESG and sustainability, has been incredibly pronounced. I've been in the sell-side industry since 2007 and doing ESG full-time since 2014. And over that time, it shifted from something that was a niche, crazy topic where you had an ESG person in your team or the broader research team, but no one really knew what they did. Everyone thought that it was a bit of black magic voodoo stuff that was done on the side. It wasn't proper investing. And it was purely just to meet values and expectations of clients that wanted to invest, for example, by removing chunks of the investment universe through exclusions to make it consistent with religious beliefs or personal beliefs. So it wasn't really seen as integrated into mainstream investing. of the biggest shifts that we've seen over this period, and this is where these charts start to hockey stick upwards, is the shift from that values-based niche investing towards the view that ESG topics are actually just about fundamental investment practices. And so it's a shift from targeting values-based outcomes to also understanding that ESG topics is really just a different way of understanding the risks and opportunities that face an issuer, and that they can be financially material. And so for me, that mainstreaming is what I've seen from ballpark 2015. I started to see in my global client base a shift towards teams that are purely focused on alpha and return generation starting to call me up and say, hey, I know you've been talking to about this for a while, but can you come into our offices and explain to our team how our traditional managers could use this? And what we're now seeing across the industry is that it's becoming almost the bread and butter of investment teams to include part of ESG analysis. We're seeing that this is being driven from not only that fundamental perspective, but also it's being driven by regulators. The SFDR regulation was highlighted previously, which I'm spending way too much time on at the moment. It's about 90% of what the industry is focused on at the moment. We also have seen a huge shift in client expectations, and COVID was also a catalyst for this, which is what we're highlighting on the right, which is that essentially what we've seen is that ESG companies, so companies with high ESG scores, are typically correlated with factors around low volatility, high return on capital, and quality. So what that means is that in drawdowns, ESG companies are typically more resilient and they typically outperform. And so during what we saw during the COVID crisis was a huge outperformance from ESG companies or companies with good ESG characteristics, and then resulting inflows into those sectors, combined with policy shifts globally towards renewable energy, creating a boom in ETFs associated with renewable energy. I think in 2021, renewables were some of the best performing funds with outperformance of 70–80% for some of these ETFs. So they've performed incredibly well over that period. So what we saw was a flight to safety, assets moving in, and non-ESG funds actually seeing outflows over this period. So again, we're seeing a policy shift, which shows the chart on the left, with a crazy amount of regulation coming in. We're seeing clients demanding it. We're seeing people recognize that ESG is just part of fundamental investing, and we're seeing the money flow towards these assets. So look, all steams ahead in terms of what we're doing with ESG. But before we get into the detail, we need to actually establish what we mean when we're talking about sustainable investing in ESG. One of the most amusing comments that I always find from someone is when I get asked, oh, does your fund do ESG? And my comment is, what do you mean? Because there are 100 different ways of implementing ESG. There are so many different ESG strategies. You can have a hedge fund which trades on a daily basis, which uses ESG insights for an arbitrage execution model. You can use ESG as part of an impact investing strategy where you're trying to do good in the communities you invest in, and you'll have the entire spectrum between it. So you can have a massively different approach. But what I personally like to think of is that you can typically try and boil this down to two key points. The first is to use ESG information to gain better insight and to try and achieve better risk-adjusted returns. So this is literally just expanding your circle of what matters to drive an investment return to include a broader range of things, such as, is there going to be a price on carbon, which could derail my carbon-intensive manufacturing business? Is there going to be, am I worried about the corporate governance of the company I'm about to invest in because the chairperson has a history of corruption? All of these sorts of things you'd argue are completely part of doing your due diligence as an investment manager. And for me, that's what that first bucket is. It's a broader range of risk and return objectives. The second area here is to target non-financial investment outcomes or the characteristics of your portfolio. And so this is really talking to value alignment. And so what you can try and do here is you can either pivot towards funds with certain characteristics. So you can have a best-in-class strategy where you're trying to only invest in companies that minimize harm and have good characteristics. It can be a thematic approach where you're looking at trying to invest in climate change or water and waste or equal opportunity and employment growth. Or it can be something where you're actually trying to have a direct impact that is measurable and attributable from your investments. And this is typically impact investing. So for me, most funds are trying to blend some form of that, and there's a bit of a scale around along those different approaches. So what that scale is shown on this slide. And so there's a lot of information here, but basically the key area here is the green, the green bar, which basically says on one side, you're just trying to make money. On the right, you're purely doing philanthropy. And then you have a huge blend of strategies between it. The really important thing to mention here as well is that if we look at concessionary returns, so this is essentially trying to not, when you move away from trying to beat the market or get market rate returns, that only starts kicking in when you're really at the right end of that scale. And this is a really interesting point because most people, when they think of ESG investing, they think, oh, you want to do good, so therefore you're giving up some return, or you're not actually having the same aggressive market targets that you might if you didn't have that objective. What this shows is that actually for the vast majority of assets in this space, they are targeting commercial returns. And it's only, and interestingly, even impact investing, there was a study by the Global Impact Investing Network, which was showing that almost 60% of impact investments are actually targeting market returns as well. So these are companies that are investing in schools, hospitals, medical development, education, and they still try and get a market return. So ESG shouldn't be thought of as something that you need to give up something to achieve. That is part of it, but it's just a very small niche. Most of ESG investing is actually trying to build in fundamental integration for better risk-adjusted returns, or it's trying to tilt towards a thematic outcome. And what we show on the next slide here is where the money is. And so you can see this, and this is the, we're using the same data source as the previous speaker. So what this shows at the bottom is you can see that ESG integration is easily the fastest growing area. And for me, this is really the mainstreaming component. This is ESG being used in traditional funds without a stated formal do-good objective. It's more about risk mitigation. The fascinating one for me here is negative screening, which has been the history. If you remember my opening comments, negative screening was historically how the SRI, sustainable investing industry, worked, which was about faith-based exclusions of excluding alcohol, tobacco, gaming, those sorts of sectors, sin sectors. Interestingly, we've actually seen that start to decline. And this is part of a shift towards a view that to have impact, it's not about not investing in an issuer, it's about investing and having dialogue and active engagement in order to drive positive outcomes. And so that's really part of the ESG integration approach, is to try and understand the risks and exposure of your portfolio and use your influence as a manager to try and tilt and improve the performance. The final one I wanted to highlight here is the sustainability themed investing. And this is rapidly growing off a small base, but you can see that impact investing and best in class and thematic investing are still absolutely tiny compared to the vast majority of ESG investments, which are based on integration and screening. And so what I want to do now is just run through what ESG integration actually means, how you can use it, and to try and unpack that a little bit, just because it's probably the most complex element. A theme investing or impact investing is pretty straightforward. You pick a theme, you invest in companies that contribute towards it. But the negative screening and the ESG integration can be a little bit more complex. So typically, if we think about ESG integration, what we're typically trying to do is to say, how can we use ESG insights and information sets to get better insight into how a fund is going to perform in the future, or how an asset is going to perform in the future? And the classic examples here are that if we take mainland China prior to 2013, 2015, where there was a step change in the focus on environmental regulation, if you were a heavy industrial company and you were dumping your chemicals into the river next to your factory, you actually would have a lower cost of business, doing business, compared to a competitor that was complying with the law, and you had a low chance of getting fined. So what that meant is that you actually had a disincentive to follow strict environmental practices because there was no downside. Clearly, though, that's a very short-term strategy. It's not a good way to succeed long-term as a business. And what we actually saw was that when the regulations shifted and enforcement really stepped up, and China wrote in an ecological civilization into the constitution, we actually started to see a huge performance differential between those issuers that had good environmental practices and the ones that didn't. And historically, it wasn't there, but it started to actually drive out performance. Partly because they didn't have to reinvest in their factories to improve operations. They weren't being shut down, they weren't being fined and closed. So what we're trying to do is to pick those sorts of issues that are directly related to an issuer and will lead to long-term value creation or be a risk in the future. That's one important point about ESG integration, is that the biggest focus is risk minimization, not seizing on opportunities. And the reason for that is that if I take a fantastic investment opportunity and the chairperson is corrupt and steals all the money and goes to Mexico to party, I've lost all my money and my investment is ruined. So the ability for downside risk is almost 100%. It can completely wipe out an investment if there is corruption, if there are problems with the business. On the upside, it's typically a complementary factor which contributes to the success of a business. So, for example, you might have a business that can attract and retain the best talent, that has fantastic development opportunities, that has good relations with community and government, so policy risk is lower, and they're reinvesting in environmental protection, so the risk of elements on that side is lower, and they're also attracting new customers because of the quality of their products. So all of that will reinforce return on capital over a longer term time horizon. But if the company is trading on a PE of 200, then it's not really going to be enough to make an investment in isolation without consideration of other factors like valuation, growth trajectory, competitive dynamic, and other areas. So it's typically tail risk that we're trying to evaluate with ESG integration as a primary focus. It's just an important point to make, because what we're looking at when we look at integrating ESG is sector by sector, what are the most important topics that really matter? And this goes back to the creation of ESG ratings, in that every rating agency goes through this similar sort of process. And the reason why is that we can take some silly examples to really draw it out. But if you have a mining company, clearly fatality rates are a huge part of how you operate. The environmental impact of your business are really important components. However, if we look at other areas, such as an IT or tech company, fatality rates and environmental impact and water pollution are not really relevant for your business as an IT company. So we have to pick the elements that are the most important for each sector, and then we have to figure out a way of rating it and evaluating performance. And that's really where the ESG data is super valuable, in that we're able to get raw data or scores of how companies are performing on these topics, and then we can evaluate the extent to which that's reflected in the valuation, but it has to be on a case-by-case basis. It's also one of the reasons why headline ESG topics can be, and ratings can be quite misleading, because a blend of an E, S, and G score can give you an idea that overall the company might be okay, but they might have really poor performance on one metric which really matters in that industry. So if you've got a horrible safety record but great governance and really good environmental performance, that doesn't mean that that bad safety record isn't a problem for your company. The way that this insight is integrated is a combination of traditional fundamental analysis combined with ESG fundamentals, which then flow up into views about the long-term cash flows and performance of an issuer. So this really goes back to traditional fundamental DCF style analysis of how do ESG factors complement your ability to accurately predict cash flow. So it can go to durability of cash flow, it can go to magnitude and size. If there's a carbon price and you're in a sector, your cost base might go through the roof. There's all of these ways that we need to be able to make sure that we're capturing these insights and factoring them into the analysis. quickly, just to wrap up, I just want to highlight some of the problems with ESG data and why ratings can be different. I like to refer this to as Mount ESG, where on the left you've got a crazy amount of data availability coming into the market. So mandatory regulation in Asia and other markets has really resulted in a crazy amount of regulation to push data into the market. So it's fantastic. In Asia, we now have almost better data than the US when it comes to ESG policies and numeric metrics. But the problem, which is shown on the right, is that the consistency of this data is incredibly low. So you have the chart on the right shows is the percentage of disclosure of individual metrics. So what you can see is that you very quickly drop to below 50% of companies disclosing an individual metric. This really matters for quantitative ESG analysis, because if you don't have a peer group, you can't normalize for country and sector factors. And so it becomes incredibly difficult to actually evaluate if a company is performing well in what context, and to get insight into how they're actually performing. The other big challenge we face is that the vast majority of data here is actually policies, not numeric data. So it's a statement of intent or a statement of a framework that we're trying to evaluate a company's performance on. And as everyone knows, policies, I always like to refer to them as similar to New Year's resolutions, in that they aren't necessarily a guarantee of future good performance. So we need to be careful with how we're interpreting ESG data and ESG scores. The other element here is that most ESG data sets are based on the aggregation of anywhere from 75 to 150 plus data points, which means that you're aggregating a lot of policies to evaluate whether a company will perform well in the future. And so again, just to be cautious about some of those elements with regards to data availability, the quality of a score, how it's been built up, and whether it's fit for purpose. And just as a final comment, if we're thinking about how this all ties back into an investment process, the vast majority is going to be ESG integration, which means we're looking for sector-specific insights on narrow topics that will define long-term performance. And we're trying to get quantitative data where possible to evaluate, compare, and gain better insight into the fundamental long-term performance of a company. The key area of this is typically risk mitigation, because it has the biggest ability to impact long-term performance. And the way that this data gets used into product creation can be through fundamental integration, which is what I've been describing, a best-in-class approach where we try and tilt towards only highly rated entities. Or you can have a thematic approach where you use an ESG score to say, I'm only going to pick companies that have an E pillar score of 9 out of 10 or 8 out of 10, or only perform well on climate change related metrics, to have that thematic or flavor business involvement tilt into how you operate. The final component is impact, which is incredibly difficult to measure and very difficult to do in a listed equity space. And typically ESG scores from third-party data providers are not used for that type of impact measurement. You need to really dig down to the raw underlying data to evaluate the extent to which a metric like carbon emissions or a metric like waste and recycling has improved following your investment. So you wouldn't use an ESG score to demonstrate it. You'd use the underlying data sets in order to demonstrate performance. So again, with all of that, just to summarize, it's critical that you use a data set or a rating which is fit for purpose and fit for where you sit within that product spectrum. Because if you don't, you can end up with incredibly poor fit between the insight you're trying to get and the bias within the data set that's actually being delivered to you.
Right, Gabriel, no, really thanks for the insightful sharing. I do think that there are few people out there with almost 15 years experience in this field as yourselves. I guess we can probably fill another whole full session with the insights you talked about today. And just for the information for this group as well in the audience, we're actually working on an ESG Masters program. So I really look forward to also have Gabriel and Mervyn in the future to have some of our guest speakers. And with that, I welcome Mervyn. Mervyn is from Schroders. He is the head of sustainability strategy in APAC. He's based in Singapore. And before that, also relevant for the group is he used to be the global head of ESG research at Fitch Ratings, one of the ESG leading rating agencies that Dr. Han shared with us before. So really welcome to today. And the topic that Mervyn will share with us today is demystifying divergence of ESG ratings. We talked a little bit about that, touched on that through Dr. Han and Gabriel, but also how the ESG rates are used to achieve different sustainability objectives. So over to you, Mervyn.
Thanks, Latman. It's always very hard to follow Gabe because he covers most of the good points. And so my presentation will be a little bit shorter, but kind of talking about, or extending on a few things that he pointed out. So just let me share my screen. Hopefully everyone can see that.
Yes, perfect.
That's great. So I think Gabe touched on this a bit earlier when it comes to the fact that the ESG ratings across different providers can be very divergent. And so here's just a few examples of plotting Reuters against MSCI's against Sustainalytics on a diagram, on an XY chart, and you can see that there's not much correlation at all. And now, like, I guess to be clear, I used to work for MSCI, so I'm not going to badmouth my previous employer, but there's a very good reason for why these scores can be very divergent. So Gabe talked about just a variety of indicators out there, right? And then you could have reported data as well as estimated data, depending on how these data providers are thinking about it. So there's not going to be scope-free carbon emissions coverage for every company. And so these data providers will be thinking about how to estimate them. And then suddenly that can already lead to a big divergence in score. Then you've got the aggregation methodology itself. So there'll be different weights placed on different environmental, social, and governance issues, different metrics to assess those issues. And then you've got to think about the mechanics of the aggregation. So if you have a sector relative normalized rating like MSCI versus a Sustainalytics, which is kind of a more, what they say is a more absolute risk measure, that already is quite a bit of variety when it comes to the final output. And so reiterating what Gabe said, ultimately you need to understand the methodology of the tool that you're using, where it might capture certain things and where it might not capture others. And from our perspective at Schroders, we try to look at many of these data points because we want to understand the different perspectives without necessarily following them really just by the book. Another thing I think it's worth mentioning that the ESG aggregated data world is evolving more and more beyond ESG rating to assess ESG risk and resilience. So you have all sorts of data out there. You have climate alignment, you have sustainable development goal alignment, you have scenario analysis tools. All of these are to cater for different things. And I think one of the reasons why we can't just have a universal lens applying ESG into investment is that our clients actually also want different things. So I think well, maybe if we go very, very back in time and people just cared about return, I think that was when maybe managed mutual funds first started. That over time evolved into understanding, well, actually return has to be adjusted for risk. You can of course get invested in emerging markets and frontier markets, but the volatility of your portfolio will be high, will be potentially higher, and you need to consider the risk-adjusted return to compare portfolios properly. I think the next bit, I think, where it's starting to change, and I think there's the ESG integration to assess risk and return, but then there's also using ESG data and tools to try and capture that impact bit, which as Gabe said, is not easy for listed equities, even harder for credit when you start having these mappings and hierarchies and subsidiaries, and then for private assets and other assets, it can get very complicated, at least to aggregate across the portfolio. And so, and another thing I think for you to think about is we're not just necessarily thinking about how ESG issues affects risk and return, but also what are the sustainability objectives of the client we're catering for, and how do we balance these three bits of risk return impact in a way that really matches their investment profile. So how do we do this? This is when it gets, and I want to say, I think the way that Gabe kind of talked about the methodology, the way Schroders talk about methodology, like the way that other asset managers talk about it, we all are going to have different ways of looking at sustainability. We'll have different tools, we'll have different angles. The way that we've done it is, at Schroders, is we recognize that there's going to be a lot of different things we need to consider. So there's going to be qualitative and quantitative analysis. So our tool Context is very much driven by our investors, and it's a stakeholder analysis. So it's intended to be qualitative. We identify what trends there are when it comes to sustainability. So it can be very different for different sectors, as Gabe said, right? It could be like waste is going to be much more important for certain sectors, whereas carbon emissions is going to be much more important for, say, energy and utilities, where emissions are much more important. And so our Context tool is very much to give a qualitative framework, for a structured qualitative framework for our investors to analyze sustainability trends and how it affects different stakeholders. I'll go into that in a bit later. But what we realize is, if we just look at qualitative, it's very hard to get consistency across desks. We want that view across different desks, but at the same time, we need them to have common performance measures to mark the homework. And so we have a tool that we use across the organization called SustainX. And SustainX is intended to quantify the positive and negative externalities that a company will have, because we think that it could potentially have an impact on cash flow in the future. So a carbon emissions of a company we would consider a negative externality, because the social costs are not really priced into the company's business cost, but that could reflect the company's business in the future because of carbon pricing, because of the change in customer demand. A lot of things can happen there. And like impact, I guess, is a word that's going to have a different meaning in different places. But by the way we think about it, we think about externalities, and positive externalities could be the innovative capabilities of a company, the healthcare and healthcare provision that it provides, reducing the social cost it takes for governments to provide medical care. All sorts of externalities are aggregated in a way which the way we do it is through a dollar value. So we effectively look at how much, what we think the positive and negative externalities sum up to for a company based off $1 million revenue normalized to US dollars. So it's a way of thinking about externalities. Now, all of this stuff may not help you to understand where things are thematically aligned. So Gabe talked about thematic funds. We're seeing a whole lot of different types of themes. It could be urban cities. It could be healthcare innovation. It could be sustainable development goal alignment. There's a lot of different stuff out there. And so we need to find ways to understand how a company is thematically aligned across a huge portfolio, right? MSCI, ACWI, IMI is already thousands of companies, and we need to do that consistently. The easiest way to do that is by revenue profile and by a company's products and services effectively. Once you start digging into the operations, once you start looking at bank lending and kind of their credit book, it becomes much harder. But thematic alignment is a really important part of kind of building products, as Gabe said. Last but not least, I think we started looking at climate change, and we do have climate change related analysis in our SustainX and Context model. So Scope 1, Scope 2, Scope 3 emissions, avoided emissions, a number of other factors. But that doesn't actually quite give you enough to look at. So we realize that climate change, you have to look at things that are very specific context, right? So how does the cash flows of your company evolve with carbon prices increasing? How does physical risk of your portfolio change as you think about insurance costs increasing and the frequency and severity of natural disasters increasing? And then you have to put that all into a scenario analysis, because we don't know what the world's going to look like in 2 years, 5 years, 10 years, but we want to understand what our portfolios could look like under different scenarios, kind of based on what we think might be likely. So a whole range of different things that you might need for different purposes. And so when I think one of the key messages I want to push across is you guys will really need to understand what tools are fit for a particular purpose. And then sometimes you have to design a different tool for the purpose you specifically need, because the thing that you need to do may not actually have a tool out there. Now, I mentioned a lot of these things in kind of that introduction slide. So context that I mentioned is very much focused on the stakeholders. And so again, a lot of ESG, as Gabe mentioned, there's a huge number of policy indicators as well as quantitative indicators. And the way that we almost have to think about it is we need some sort of structure to that analysis, and you can have that structure in different ways and different issues. The way we think about it is in terms of stakeholders. So because we have this externalities models, what does a company do that could potentially affect its communities? So if you're building a mine somewhere, am I going to be disrupting the local population with that mine? If I am selling to customers and I'm selling them in a way that misrepresents my product, then that is a externality that could potentially impact my business in the future. The same can be applied to regulators. The same can be applied to the general environment when it comes to carbon emissions. We think about a lot of our analysis in this stakeholder context to think about, okay, what does that mean for the company? The way that and again, I don't want to go into this too much detail and show the specific approach, but just really highlighting that again, there's a lot of ways where ESG scores and ratings could differ, because you might weight the impact on stakeholders differently. You might have different considerations of themes. You may select different metrics. And then there might be qualitative analysis at the investment team level where their subjective views may differ. So we could have different teams, let's say in credit and equity, have different views on how sustainable a company is or how significant a particular trend is. And so again, having a different set, having a structured approach at least gives a transparency through the process, so that we know what views are actually made in that ESG scoring and analysis. Now, again, I think I talked about SustainX and kind of how it was working before when it comes to understanding the impact on society. I think the main point is, like, when you look at ESG ratings and scores, like MSCI has a industry adjusted score and then a key weighted average key issue scores, and then that all gets aggregated into a sort of normally distribution rating of AAA to CCC. Sustainalytics would have a 0 to 100 score based off of the risk of a company. So there's a lot of different ways you could aggregate into a final number, which can make it difficult to compare. With SustainX, we're looking at dollar value of externalities, positive and negative, of different issues per $1 million sales. That's another way of thinking about it. And once you start looking at other tools, and I'll go into that later, that end unit is going to be different. And so when you're comparing ESG score and ratings, I think it's really important to understand what that means. Like, what are the distributions? If you applied that score and rating straight out, is there going to be emerging market versus developed market biases? Is there going to be sector biases? That's all going to differ depending on exactly what score and rating approach you take. Animated slide was a little bit too fancy. I'll jump straight through the animation. But the ThemeX concept is, okay, how do we think about the products and services of a company being aligned to different issues? And again, like, the idea that a company may be aligned to a sustainable development goal and it could be aligned to multiple sustainable development goals, that's a pretty common idea, and there's a lot of tools out there. Where you're going to get variation is how positive and negative contribution is there to a particular SDG. How do you aggregate all these SDGs together to come up with an overall SDG alignment? And then when you're designing a product, so for a client that wants to be aligned to either a subset of SDGs or the full set of SDGs, there's going to be variations. And so the image on the left shows you an example of a product we have for a client where we have environmental, sustainable infrastructure, responsible consumption, inclusion, and health and wellness. all of those things are tied to multiple SDGs because that was the way that a particular client wanted to structure it. But there can be a lot of different variation when it comes to what a client may want. And so again, when you are thinking about this, again, understand that even when you talk about something like SDG alignment, there can be a huge amount of variation when it comes to how a particular third-party provider or an asset manager might think something is particularly aligned or not. Now, climate change. So this is probably the most complex. I won't talk you through everything, but climate change requires a whole different range of things. So you need to understand things from the macro level. So we have something called the Climate Progress Dashboard that looks at 12 different indicators to understand, okay, where are we on the route to net zero? Like, how do we, if we're looking at things like fossil fuel production, fossil fuel investment, carbon pricing, political ambition, all of these will be based on some kind of quantitative indicator, right? So political ambition will be based on the net zero targets that governments have set. Oil and gas investment would be looking at fossil fuel investments globally in a company. And we look at that and compare it to an IEA scenario at different temperatures to go, okay, well, if we need let's say 2 trillion to get to 1.5 degrees, if we're at 1 trillion, then we must be somewhere we must be on a trajectory that's something a bit higher than 1.5 degrees. And then we use this and then aggregate it together to give us a rough indication of where are we on the world of net zero and which parts are there going to be most work. So carbon prices has increased significantly, particularly in the EU. So that temperature alignment has been falling significantly, but something like fossil fuel investment dropped a little bit during COVID, but has started to pick up again. So there's going to be all these sort of things where it's going to be important to look at to understand the macro level of climate change. Then we need to look at specific concepts because like I said, there's a lot of subsegments to climate risk. So Carbon VaR is a tool we have that tries to assess the impact on cash flows of carbon prices going to $110. So we use the 110 number just because, Carbon VaR uses $100, and we use $100 because the IMF mentioned that $75 was a global price that you might need to get to a 2 degrees world. $100 is something that we think that developed markets will need to get to because emerging markets will need a lower carbon price. Now, how does that impact companies? Well, I'll just talk about Carbon VaR, not the other tools for now, because there's a limited amount of time. But what we realize is just because a company has high carbon emissions doesn't mean it's necessarily the most sensitive to higher carbon prices. So if you have an example of the European emission trading system, what we found was a lot of the utilities in Eastern Europe and in Germany actually didn't bear the costs of higher carbon prices that much because they passed on the cost to their retail customers. So you saw prices on wholesale and retail energy go up, and the company itself was not being that sensitive. So Carbon VaR, as a tool for us, looks at what is the company's industry structure, how likely are they going to pass on carbon costs, and what does that mean from a cash flow perspective? Again, it is one area of climate analysis that can get very, very complicated. Physical risk can get even worse. And when you start thinking about stranded assets, understanding the geographical distribution of assets as well as the lifespan of assets, things can get much more complicated. We then use that toolkit to start thinking about what is that investment, what does that affect our risks, how does that affect our investment allocation decision. But risk is not the only thing that we're thinking about at the moment, because Schroders themselves, we have a net zero target and we're committed to a 1.5 degrees temperature alignment for our portfolio by 2040. And so climate alignment looks at least in the way that we have assessed it, we look at the targets that companies have set and how aligned to a 1.5 degree scenario, or what temperature are they aligned to based on those targets. And then we have to understand not just the risk profile of our portfolio, but effectively where are our companies, or what stage are our companies that we're never invested in on the transition journey. And so once we understand where they are in the transition journey, we want to help them go ahead and push further ahead. So we need to measure the outcome, so understand what targets they've set, what actions they've made, what actions they're doing from a net zero perspective, and then how they're organized to achieve that transition. And then we have to engage with them through a climate framework. Now, I want to get two messages from given the topic. It's the first is climate can get very complicated, and the tools that you use are going to be equally complicated because of this. And then when it comes to climate, a lot of us are not just thinking about it from a risk perspective, but also about driving the transition. How can we contribute to companies moving to towards a low carbon transition? And that requires engagement and an engagement framework. And we use that data and tools to help inform how we engage with those companies. So another way that ESG scores, ratings, and data are used. And the way that we use that is going to vary depending on the data sources we use will depend on the issue that we really want to focus with a company, as well as region, because there's a different regional availability of data sources. I will skip the active ownership and environment, but I think just, hopefully that was gave some insight to how we use different tools to look at different issues.
Thanks, Mervyn, for the sharing. I'm sure many of the participants have made screenshots of the very nice and visual depictions of it. There's a quick polling question for people. Can you please answer that? I see people are doing that already. To me, it was already sort of a very quick sort of shortened MBA around ESG, so that's great. For me, there were definitely a number of key takeaways that I got from it, including that there is a ESG amount of data available. There are different tools out there. It needs to be fit for purpose, at least for Fidelity as further as I understand. You have your own proprietary framework to make sense out of that data, and you use that to support your clients. And I recall one of your slides, Mervyn, was around, and I think we're now starting in the panel already. One was around stakeholders, and one of them that I want to pick up is on the regulators, and probably questions for both Gabriel and Mervyn. So I think we're seeing an influx of ESG regulations, particularly also on the disclosure side. Do you see that whether this will lead to standardization in the market, Mervyn? And of course, Gabriel and Dr. Hahn, feel free to chip in afterwards.
Yes, happy to start, but like I said, Gabe usually comes out with a more intelligent answer, so I just go with the initial bit. Standardization, I think I hear that word a lot. You hear that in every ESG panel and ESG conference, and everyone wants standardization. I think the usual thing that I throw back is, what are you trying to standardize? Because there are certain things that are easier to standardize, there are certain things that are much more difficult. So when it comes to ESG disclosure and company disclosure, you can standardize to a certain extent. So the types of metrics that are collected, how those metrics are ultimately aggregated together or used to calculate the final reported number, and then how it's presented. Now, of course, there's always going to be a bit of variation, because there's going to be very company-specific considerations, regional considerations. A conglomerate structure, for example, could be very different to a single-line business. There's all these things to be considered, but you can find ways of standardizing the hard data disclosure. Now, I think where it gets much more complicated is ESG ratings and aggregated tools, as well as how investors choose to use that data to analyze ESG. Because just because there's all this data out there doesn't mean that Fidelity's ESG product is going to be the same as the BlackRock product, going to be the same as Schroders product. We aren't going to all have the same way. In the same way that we don't all have the same financial view, right? There's different credit ratings out there. There's different investment views out there. You can't expect a one-size-fits-all ESG approach, because it is a complex subject requiring both qualitative and quantitative analysis. And so ESG analysis, I don't think will be standardized anytime soon. I think there will be evolution in the way we analyze a lot of these issues. So stranded assets, we're going to do a much better job of, because we're going to have more geographical and geospatial data to use that to do that analysis. but doesn't mean the methodology is the same. And then I think the next step is, okay, ESG ratings. I would not expect ESG ratings to become standardized in the same way just because there's going to be different viewpoints out there. There's going to be different aggregation processes. There's going to be different use cases. And so again, things might improve because the quality of data improves the analysis, but it doesn't necessarily mean standardization in that space.
Yeah, perfect. Thanks for sharing that. Gabriel, I see you.
I completely agree with Mervin's comments. So he's done the heavy lifting for this one. So the way that I think about it is that and this is literally just reframing his comments, is that if we think of underlying data and building blocks and carbon emissions and what that means and how you report it, and where you draw the fence around your organization is, and when you aggregate, when you don't, when you roll things up to an entity, when you leave it as a subsidiary level. All of these sorts of accounting style rules around ESG data provision, I think that there's huge rooms to consolidate, provide universal data sets, and to just have one point of truth. And for me, that's the building blocks and inputs. And I see it as the same as financial data. So a company can't have a creative version of revenue. There's a definition of revenue and it's in accounting standards, and that's how you report it. And for me, the underlying components of ESG are moving towards that level of standardization. The other side of it, where I would really not want to see consolidation or harmonization, is one view of what an ESG rating is. And the reason why is that if we look at credit ratings, a credit rating is measuring a chance of default. So you have a very specific, everyone agrees on what you're trying to measure, and you can do analysis on all of the financial data that support that and come to the similar conclusion around what's going to drive that outcome. If I think of an ESG rating, I could have a measure that is trying to measure impact. I could have something that's trying to measure tail risk. You would have completely different scores because you're trying to measure completely different things. And in the paper that Dr. Han mentioned of aggregate confusion, one of my favorite findings from that was that it was actually the methodology which was the biggest difference in different ESG ratings, which again just goes down to the point that it's not necessarily a data problem or that there are data problems, but it's actually the fact that people are using that data in massively different ways with different aggregation approaches, different end objectives. And so I think it's actually not the right outcome to try and drive towards consolidation of ratings or harmonization of ratings. And the final point that I'll steal from Mervin here is that it's exactly the same as an investment view. You use the same inputs, but if the entire market thought a company was a buy or a sell, and then that was the rule for whether you've got it right or not, the entire investment industry would be incredibly challenging if a regulator came in and said you all have to agree when to buy a company. It's not a feasible solution, and I think it's misdiagnosing the problem.
Thanks for sharing that different viewpoint. I want to stay a bit longer on the regulatory topic, also given I used to work in the regulatory risk space back at the Big Four. I mean, there's also the question around, so we have all these ESG rating providers. The study that Dr. Han shared mentioned a number of the leading providers. On the one hand, I'm also curious, do you see more emerging players than the 4 or 5 that you mentioned? If it's not appropriate to share, we can skip that question, obviously. And the other question I'm having, but should these ESG rating agencies be regulated? I had a discussion 2 weeks ago with the FCA's new head of ESG. He had his opinions around it. I won't share this here, but also curious what you think about the regulation of ESG rating providers. Maybe would that lead to a consolidation of these providers? Would regulation be actually a good thing for investment managers, for issuers, for us as the end consumer? Curious about your view. And as I said, where not appropriate, just don't answer the parts that are asked.
Who do you want to jump in for that one?
I see also Dr. Han opened her mic. If you have anything to share, yeah.
Okay, so actually I have some question. I mean, as a academic researcher, I'm using the data. I mean, the data is the processed data, right? I mean, if I directly extract the data from the website, I can subjectively define as some specific variable or something like that. But actually, right now, if I subscribe the data from some specific company like ESG rating provider, so I'm just wondering whether is there any specific rule because you guys the firstly extract the data and then make some categorize the data specific depending on the information. Because what I prepared for the presentation and while I was working on some data, I realized that depending on the company and depending on the industry, the report is really very different. So the informations are varying a lot. So I'm just wondering how the people, the company can make a decision on which information could be some specific category. So I'm just wondering about that. Do you have any idea about that?
Go for a moment.
No, Gabe, you start.
Okay. So it's a great question, and it's really at the foundation of the problem with trying to evaluate and help build an ESG rating. And so both Mervyn and I have spent way too much of our careers looking at ESG ratings and building ESG scores and frameworks. And when you look at it, the first thing that you're trying to do is you need to go through that materiality mapping exercise of what matters for each country, for each company. So if we're looking at a resource intensive company, you want to know about their supply chain, about the environmental practices and where they're getting their inputs from. And so you'd expect a completely different style of sustainability reporting or integration into an annual report of what matters for that company than you would for a bank or an asset manager or any of these other sorts of companies. So there are certain metrics which are transversal across all sectors, which are typically in corporate governance, and then elements of social, which relate to most sectors and are relevant in others. For everything else, it needs to be company sector specific. The challenge here is that typically what you're trying to do with an ESG rating is compare and to get insight as to whether an issuer is good or bad. So if you want to do that on a quantitative basis, you need, as everyone knows, you need the critical mass of comparable issuers. So the problem with this is you immediately have a tension between building a large pool that you've got that you can do statistical analysis on versus throwing in companies that are slightly incomparable. So for example, if you're looking at the consumer space, is a supermarket the same as a department store in terms of what drives their ESG performance? Do you need a separate scoring group for supermarkets? If you do, and you're using a single country, do you end up with 4 in your sample? And so you want to know what matters for supermarkets in Hong Kong versus what matters in Australia. You'll have different issues. And so then do you end up with a sample where 1 is good, 2 are average, and 1 is bad? And does that actually tell you anything? And so there are all of these problems about absolute versus sector relative versus building peer groups versus removing bias. And it all goes back to your question around how do you actually extract insight from the raw data that you're seeing. What most people do, so an MSCI approach, is that they have a global investment universe and they benchmark people against the MSCI ACWI in terms of looking at performance. For Sustainalytics, they'll take it on a sector by sector basis and they try and measure exposure and then management of an individual issue on a sector basis. For us, we use our individual sector analysts to give qualitative insight based off the data regarding how effectively risks are being mitigated by a company. So there are quant-driven approaches, there are qualitative-driven approaches, but this is exactly why you have the lovely dot charts that Mervyn put up, which just show that there is, like, any point along this journey, you can come up with completely different answers. The other, like, I'm going into too much detail, but if you've got a data set, you've picked your supermarkets and you want to evaluate them, do you rank them all out of 10? And so it's an absolute ranking, so you can have 7, 8, 9, and 10 as the 4, or do you do a normal distribution and do a Z score, so you essentially get a relative positioning between them. So 7 out of 10 would be bad, and 10 out of 10 would be good. And depending on the topic, the metric, and the insight you're trying to capture, that scoring methodology and calculation methodology could be appropriate or it could be inappropriate. And then the other problem is that once you've done that for each metric, you then have to choose how you aggregate them up at a issuer level, a pillar level for E, S, and G, and then how you combine them into a final rating. And so this is exactly why there is just so much room for interpretation, and why it's critical that each step of that process is tailored to your investment insights. And so that when you're using the score, if you've done a Z-score normalization, you know what that score signals, that it is a relative assessment versus a peer group. But if your peer group is in Europe and they're large cap companies, even a bad company is probably pretty good. Whereas if you were doing it in emerging markets, even if you were at the top of the pack, you probably still have some risk. So again, there are a lot of different ways that we need to be able to interpret the data.
No, perfect. I'm sorry, from our...
I was going to jump in because it's a question that I've thought about a lot, because I think like I'll ultimately probably end up in academia at some point when I decide to pack in the private sector. But I think one of the things that you read in the newspapers and you read in a lot of articles is, ESG is correlated with performance, or like doing good means doing well means also doing good, or like all these statements. And a lot of this research and analysis comes from looking at effectively an ESG rating, or taking a meta study of like multiple of these assessments and going, oh, okay, well, how does that look versus performance? And then you may control for certain variables, but ultimately it's kind of assessing how do ESG funds perform, or how does different things perform? I think the challenge, I think, kind of relates to Gabe's statement, the things that Gabe mentioned, is every ESG methodology or rating and score is embedded with a lot of assumptions and a lot of ideas that are going to be potentially very different to each other. So when a lot of this analysis, when I read the newspaper, it's like, okay, it's not ESG in general that's outperforming, it's ESG as measured by this approach, like Sustainalytics or MSCI or whatever, is outperforming. And probably even then it's only for a certain time period, for a certain region, in a certain context. And so I think the newspapers, a lot of media out there really want to come out with one answer, and there's ESG is good or bad, depending on which side of the fence or which part of the agenda they want to deal with. But in reality, we're talking about very aggregated data with a lot of subjective views. And so like I think it's interesting kind of as you dig down into, okay, well, why a particular ESG scoring or score or rating framework might outperform. It could be unintended regional biases. It can be unintended large cap to small cap biases. It can be sector twists. It can be all sorts of different things. And so I think I think as like for a lot of the researchers out there who are doing work on this subject, I would really encourage to dig down and look at multiple different scoring and rating agencies, understand the methodology. What does that mean from a distributional structure or geographical regional distribution, sectoral distribution perspective? And then really then dig down to that question of, does it underperform or whatever you're using it for? Because I think that's really key.
And final comment on this. Sorry, you asked a question that both of us are far too passionate about, is that if you do backtesting on ESG policies, it has zero relationship to company profitability or performance. If you look at underlying material topics, so you take environmental issue or environmental performance for a mining company and those sorts of things, and look at the raw data, that has a good performance on the raw data has a great correlation with high returns on capital and good operating metrics. So it again just depends on how are you building your score, what metrics are you using, and what is the predictive power of those metrics? Are you measuring a framework which is going to be just correlated with company size, or are you measuring a numerical data which is going to correlate with underlying performance? So there's a lot of crazy elements here. And I'm also conscious that I owe Lapman an answer to his clear question.
No worries. No worries. I mean, I'm happy that we're so passionate about this, and it's very useful for our research team to get the practitioner's view, given that I think you combine, I don't know, probably have 30 years of experience into this field. But before we go back to the regulator and regulation question, maybe another quick one from me, having heard what you have shared, is the material issues per sector are different. I mean, sometimes I look at SASB. Are there other sources where you can, other than proprietary sources, to understand what are the material risks by sector, given that some of our audience are also from corporates? Is there any source for material risk by sector that people can take a look at or study? Just curious before we move back to regulation. Other than SASB or, okay, that's quick. Okay, maybe Mervyn.
Yeah. You know, I can start. I think stuff like SASB gives you a framework of what issues that are potentially material. But I think, to be honest, a lot of this analysis, I think when you're thinking about, okay, like what's going to be a material for the energy sector, it's probably going to be emissions and a number of other things. What's going to be more what's going to be more material for a data heavy company than data privacy and cybersecurity is going to be more of an issue. And so I think I'm not sure about frameworks. Gabe might have more of an idea, but I think the thing with even looking at SASB, I think it's worth understanding why things get chosen, right? And then in what context that materiality means, because I think there's a lot of conversation about double materiality, right? So what is the impact of a environmental and social issue on a company, or governance issue on a company, versus what is that company's impact on environmental and social issues? And so SASB is more leaning towards the prior when it comes to risk, but then there's kind of more, like, for example, the GRI framework is more focused on the impact side. And so there's a lot out there, but again, like, would consider materiality in multiple aspects.
Thanks.
And for me, completely agree. I think that SASB is a reasonable place to start, but to Mervyn's point, you really need to know what you're trying to measure. Like, are you measuring impact of that company or the general ESG credentials, or are you using it as a predictor of future financial performance? And then also over what time horizon, because as you extend the time horizon, double materiality starts to blend into financial materiality. So it can be, we need to be careful about what we're trying to measure in the time horizon. They're looking at the data providers. Most of them provide a fairly transparent methodology documents that you can get a look at, which provide the big picture categories that they focus on in terms of for sector what matters. What I always encourage people here is that less is more, in that if you're struggling to think of how an issue might influence the performance of a company or really be material, it probably shouldn't go in there. To Mervyn's point, you can usually very quickly pick the top 5 for most sectors and get an idea of what's going to matter. And this is really about trying to make sure that what goes into the model is as focused as possible, because you don't want to have very difficult to make absolute statements here. Depending on what you're trying to measure, if it's financial performance, you typically don't want a very broad suite of metrics. You want it to be narrow and focused. If you're trying to measure the culture of a company or response to sustainability in general, a broader set of metrics might give you an idea of the breadth of their focus beyond financial materiality. So again, depending on your objective, but if it's trying to do correlation analysis between financial returns or risk-adjusted returns and ESG, then a narrower group is typically better, and then also metrics that you can actually quantify and measure. Because this is the other element of a model creation process, is that it's not just the first step of what is material, but it's then, can I get information to actually support that is high quality and transparent, or should I take a topic that I think might be less material, but where I've got higher quality data that I can actually measure in a more meaningful way.
Thanks for the nuanced viewpoints for us to take away. Going back to the regulation of ESG rating agencies, looking forward to hearing your view. I mean, also in the light of conflict of interest that Dr. Han mentioned before, what do you think the future of, let's say, regulating ESG rating agencies and data providers? What are you seeing in the market in terms of trends? What can we expect, actually? Is it a good thing, or is it not a good thing, I guess, depending on which hat you wear as well?
I don't mind starting this one, having been in a credit rating agency as well as an ESG rating agency. Is it a good thing? I think I think an important question is how is that regulation going to be applied, and what is it going to do, right? Because I think if we really simplify it, the most basic consideration is, okay, regulation helps to protect the integrity of the system and for us to be transparent and understanding of how the system works. But the worry is that it would stifle innovation and kind of the development of the organization. And so there's in that spectrum, there's always going to be a place for at least some set of regulations, right? Because with all these conversations about greenwashing or like conflict of interest, and like you mentioned, where as we've seen, as we've kind of historically with how credit rating agencies are regulated, a lot of the considerations are to do with how do you manage that conflict of interest, how do you make sure that operations don't lead to the potential for those rating decisions to be affected by business operations. And then you have these Chinese walls, and you have all these things. All these can be good. I think what the danger would be is because ESG ratings and scores are so complex, as we described the different use cases for different ways of looking at things, is for regulation to be too prescriptive and go, this is an ESG rating, this is what applies, and then all funds and all products have to follow this rating or structure. And then suddenly everything has to filter into this rating structure that may not make sense for everything that we're trying to do. And so I would say, yes, there's always going to be a place for a regulation. Now, how far and what does that look like is what's going to be important in terms of how it benefits the overall industry.
Thanks for a very balanced response.
Yeah, I think I totally agree with that, because regulation should be necessary, I believe. Otherwise, it's going to be a little like a bubble. So some regulation, I mean, right now, I think the fund trying to put the money on the get a better rating or from the different data provider. So I think the regulation, if there exists a regulation for some standardization for the data provider, it will be very nice in industry and also the financial market.
Maybe a different angle to ask Gabriel is with the many rating agencies out there are many more than the ones that we mentioned over the couple of presentations. We see a consolidation of those, and where do you see the from a conflict of interest perspective? I assume that the advisory business is not huge at the rating agency, but also interested in your view, consolidation versus the role of advisory.
For me, a lot of rating agencies are starting to shift more into advisory, and part of this is that because they have such large data sets, they're able to evaluate who's leading, who's lagging, and also to try and add more value-add services. Increasingly, if we think that data collection and data provision is becoming standardized, what most large asset managers like Mervyn and myself, we use the rating agencies not for their final rating, but for the raw data and inputs into the process so that we can come up with our own ratings and tools. And so if that data level is becoming more standardized, it creates an incentive for them to try and offer more value add services on top of it. So I think that that's the direction that the market is shifting in that regard. From my side, I think that some level of consolidation is natural, but it would depend on what segment of the market. So there are huge economies of scale within ratings provision, in that if someone signs up a new client for their rating, it costs them almost nothing and it's all incremental revenue. The other challenge is that the breadth and scale of the operations typically mean that they're very labor intensive and systems intensive in order to be able to provide a complex and broad coverage of a rating. So the industry itself lends itself towards some level of consolidation. What my personal view is that we'll end up with a consolidated core of a few providers who are the big ones that we've been talking about today, and then a whole set of specialized niche providers that have a specific market focus or topical focus, which doesn't make sense for the big companies to actually focus on. So we're seeing this already with there's Chinese language specific data providers that use NLP engines in order to pick up and get insight into that individual markets. Amusingly, the most NLP data providers actually translate all languages into English and then try and do NLP on it. which is amusing. If we're all, as someone who's not talented in languages, using Google Translate to translate other languages gets you some pretty interesting comments sometimes. So using that for nuanced insight into the performance of issuers and as a way of building up data can be difficult. But what we've really been talking about mostly is the mainstream data providers that take data from issuers and then feed it in. Where the fragmentation is really occurring is at the edge of this, where you don't need large teams and people, you need processing power. So you build an NLP engine, a machine learning approach, or you get access to novel data sets from building a crawler to trawl through government reports or industry data sets or journal articles. This is really where we've seen the huge fragmentation of sentiment analysis and other sorts of areas of alternative data providers. So I would anticipate that that continues, just because the barriers to entry are currently low and there's a lot of value to be added. In terms of the benefit of regulation, from my side, I think that there needs to be some form of regulation. Completely agree. Where I find it difficult, though, is that I think that we risk, if we set the bar too high, we risk precluding this type of innovation, new entrants, and we just end up with unintended consolidation towards the big players that, and we'd say, okay, that's what an ESG rating should be, or ESG information provider should be. From my side, the level of transparency and disclosure from data providers is actually really good. If you're a prospective client and you ask them for the documentation, you typically get sample data sets, technical guides, white papers as to how they've built their model and how it works. It's difficult to access that from the outside. You might not always get that level of information if you're not a prospective client. But from my side, it's almost a case of letting market dynamics play out, because at the end of the day, we're paying a crazy amount of money to all of these data providers for all the data. If we believe that they're low quality or they've got conflict of interest, we have alternatives that we can go to get different data or different sources. So from my side, I don't see the conflict of interest as a huge issue at the moment in that the primary revenue is coming from players, the consumers of the data, not providers of the data. The other side of it is that I'm pretty confident that the direction of travel here is going to be supportive of this type of approach. So I'm not super concerned by it at the moment, but it could change if we do have consolidation to a handful of players. Then it would start to become much more of an issue.
No, thanks for sharing that. I mean, my understanding is that most of the ratings are based on publicly available information. I think issuers have the opportunity to provide additional data, but I think typically they do make that publicly available soon afterwards. But I think, are there elements which are more at the discretion of the ESG rating providers? I'm thinking about things like a controversy rating, where they look at, is there enough news, whether they leverage that in the rating. Can you share a little bit about that room for discretion and how that impacts an issuer?
Mervyn might have something interesting to comment on this from his experiences, but working inside the walls of the rating agencies. But from my side, I think that the vast majority of ESG ratings are built on quantitative models. There is room for interpretation of some elements. So, for example, Sustainalytics gives a strength of policy rating, which is essentially based on, do you have the right keywords in your policy and do you have the right coverage elements? We did an amusing exercise of getting a few people in our team to get their guide and try and rate policies, and we came up with massively different outcomes depending on who was looking at it. So I think that there is room for subjectivity in some elements of a score, but the vast majority are quantitative driven, based on just clear metrics and thresholds or presence or absence of data. If we look at controversy ratings, this is very, very subjective, as is UN Global Compact compliance or some of these other international standards. Every asset manager has a different list of companies that are in breach of UN Global Compact standards. So it's an area where you can have some subjectivity. Typically, though, I would argue that it's issuer engagement with the issue and management of it which can tend to get a more positive rating. So if you're responsive and are providing additional information, context, and how it's being managed, then you're more likely to have a positive rating, because most controversies have two components to it. There's an exposure component and a management component. And so if you're proactive in responding and dealing with the rating agency, you can potentially get a less restrictive rating on the controversy. But again, there's the weight of subjectivity differs massively by rating agency and also component of the rating.
Yeah, maybe I'll just add a little bit on. I think the methodologies are very much outlined, right, in a lot of these ESG rating score providers. So if they went too far and just subjectively threw a number in, it's going to be quite clear that that's being done. So I don't think that's where the potential conflict of interest in. I think where there may be more challenges in an advisory consideration is, okay, well, if you just write your policy like this without changing anything, this is how you get to your optimal score relative to peers, or like a lot of ways where, because of the technicalities of the methodology used, things can be adjusted in a way where you get to the best of what you could be without necessarily changing any of your sustainability actions. I would say then, to be honest, the subjectivity is probably for me less about the kind of the tinkering manually, but I think at the actual system level, where you like, a lot of things can have embedded subjectivity. So what take one example is scoring a company well because they have got dispersed ownership when it comes to shareholding, right? And so there's a debate there, because if you ask some fixed income investors in Asia, they go, well, actually, we've got like this 15-year, 20-year history with this family who's always repaid their debt, and they've managed it in the company in a way which seems like a strong steward of the business, where we're actually probably more confident than certain dispersed ownership structures. And then, okay, well, like if you just have in your aggregation methodology, it's easy for yourself to have these implicit views on what is good or bad when it comes to a sustainability consideration. And there's going to be more controversial issues out there, like with the taxonomy in Europe. We've seen already the debate on nuclear and gas and what does transition mean. So I think there will be subjectivity embedded, but not necessarily in a way where it's about tinkering for conflicts of interest.
And just to really highlight that point, it is really, really easy for an issuer to increase from a low score to a high score on any ESG rating by doing a gap analysis of what policies you need and how to write them. There are ESG consulting firms whose their entire job is to write sustainability reports to get high ESG ratings. They'll even submit them for ESG awards on behalf of the company without the company being involved. It was quite amusing. I was on a judging panel, and they said they actually put the name of the consulting company as the submission as opposed to the name of the company they were representing. There are a lot of challenges here. And for me, again, this is why it goes back to, what are you actually measuring? Are you measuring a policy framework and the existence of the right board, committee members, and other sorts of elements, or are you measuring actual outcomes? And the best example of this that I love using is that if you look at board independence, which people typically agree is an important part of corporate governance, the level of independence around Asia depends entirely on the country that you're in and the minimum standards set by that country. So, for example, if we look at South Korea, they've got 50% independence because it's mandatory. If we look at Hong Kong, we've typically got lower levels. Mainland China, you've got 30%, 33, because a third is the mandatory level, and similarly across other markets in Asia. And so does that mean that every board in South Korea is more independent than every board in mainland China? Debatable. So you also have, and also better than most other markets in Asia, again, debatable. So again, it's like, what are you rewarding by providing that framework? And so for me, I'm much less concerned, like I agree with Mervyn here entirely, I'm much less concerned with subjectivity and conflict of interest from that side. I'm more concerned with the potential for a deliberate orchestration of a higher ESG rating without actually changing performance or how you operate.
Got it. I think one key takeaway for me is definitely look beyond the data. Why is it used? does it fit your own purpose? I think the nuanced view is very useful for myself. If I combine some of the questions I'm getting from the audience, sort of paraphrasing it, one was around related to greenwashing. Maybe I'm looking at Mervyn for that. I mean, these regulations that we're talking about, have they been successful against greenwashing, and how do investors that go to a Schroders, go to a Fidelity, or even want to know more about a specific issue, how do they protect themselves, well, as good as possible against greenwashing? Are there tips that you could share with us?
It's interesting. So like this, the greenwashing word seems to be all over the FT and media articles lately, and a lot of it is like, oh, I can't believe this ESG fund has fossil fuel exposure, or like something along those lines, right? And I guess those who've been in the industry for a while, it's like, oh, okay, well, actually, like ESG or sustainable fund label can mean all sorts of different things in different contexts, depending on how an asset manager applies that ESG framework, what that fund is specifically trying to do, and that's actually not a surprise at all. Now, and I think all of this is related to both the differences in views on how why ESG is being applied and how, as well as subjective needs of clients, right? So there's going to be, like I said, clients who want SDG alignment, who want climate change transition, or who have loads of different objectives. And so I think ultimately the key for me is not to necessarily have regulators come in and mandate what is green and not green. I mean, you can have thresholds and say, okay, well, this is a way that the European taxonomy, or whatever taxonomies in our regional context considers a sustainable activity, and it gives them an indication. But ultimately, I think what we need is the transparency to say, okay, we want to be able to see what companies are doing, and if they're saying if they're doing what they're saying doing, and that same for fund managers as well, right? Is there enough transparency for a consumer to go, okay, like the asset manager has said they're doing this, and this is exactly what they're doing. They've got evidence and different things to back that up. What I think will be a more difficult, and I don't think necessarily the world we want to get to, is for governments or one type of organization to go, this is the definition of sustainable, and that's how you that's how you achieve it. Because I think even different governments and different regions and different people are going to have very, very different or can have quite different definitions of what that sustainable word means.
Got it. Thanks for the last question. I promise around regulation is in the whole enforcement and litigation space. I'm hearing some lawyers that I'm talking about that at some point we'll see more ESG related litigation. I think there are talks about class actions in Hong Kong when that will be implemented. Do you see anything globally or regionally around ESG related litigation? I definitely see things around shareholder activism related to ESG. Maybe less here in Asia, but definitely I think governance is starting a bit with Toshiba, 7&i, ExxonMobil, Shell. Do you see litigation and maybe enforcement by regulators as something coming our way, or should we be worried about it at all for now?
For me, I definitely think that it's going to increase. So part of the challenge here is that, so I completely agree with Mervyn in that it's a question of, are you true to label? Is basically, if you make a statement about your fund, or a company makes a statement, are they behaving in a way which is consistent with that statement and that assertion? What I find challenging is, I completely agree, you've got a fund which is a best-in-class ESG fund that's called sustainable, and then someone will attack it for holding a certain industry. And you're like, but I never said I wouldn't hold that industry. That's not what I'm doing. And so you've got different interpretations and views of these issues. There was recently a case in the US where someone had invested in a sustainably branded fund, and they believed that they had been misled by the asset management or advisory company that had put them into it, because it was a best-in-class fund and not a thematic fund tilted towards sustainable topics. So I think that there's a huge part of education that needs to happen in order to remove some of these issues. I think disclosure is a critical issue. What we have started seeing is precedents in a lot of markets for this type of behaviour and action. There was someone in Australia who sued the government for not taking into account climate risk in terms of government bonds. And so we've seen laws in France where it's possible to sue any company that isn't taking into account environmental impacts and climate risk in terms of their operations. So I think that there is a growing precedent for legal action to occur regarding integration and management of ESG risk, but then also for mislabeling and representation of products. But for me, this, like, some of the areas we've seen on it are around that type of representation or misrepresentation component, and I think that that's going to step up. And I think that the most important element here for asset managers or distributors of funds is to ensure that when you make a statement about the fund's credentials, you provide incredibly transparent commentary around what that actually means when you're doing it. For example, if I'm clearly Australian, if I sell a fund in Australia and I say it's sustainable, there will be expectations from the local market around what that means, which is very different from selling the fund in Hong Kong and very different from selling it in Europe or the US. And so if you've got the same fund which is sold in different markets, how do you ensure that you're actually meeting those local market expectations and not opening yourself up for allegations of misrepresentation?
Perfect. Thanks for sharing that. I mean, maybe we'll move more outside regulation. And a question maybe more for this region is, I think in Asia, we're hearing more about the concept of transition financing. I think Asia is in a sense a very unique region, as in we try to balance the drive for decarbonization. At the same time, with many economies still in emerging developing stage, there is a need for growing energy needs. Mervyn, I know you have some views around it. It'd be great if you could share how you see companies or governments balancing that sort of those two considerations.
I think you see this in the way that a lot of regulation has been penned and how it's played out, right? I think one example would be the Singapore, the GFIT task force and the ASEAN taxonomies, which have come out with this traffic light system of red, amber, and green to really fit that transition activities in amber. And in some ways, it's kind of worked quite neatly relative to the kind of the EU taxonomy discussion where it was effectively green or not green. And so the conversations about nuclear and gas became very much fueled because there was no amber to think about. Okay, well, maybe there's differentiation shades of greens that or amber that we want a policy mechanism to have. But I think ultimately there is going to be this consideration where we have more fossil fuel intensive economies by nature across most of Asia. We have a lot of economies that are still low income, the Laos and Cambodias of the world, where power provision, energy stability, all that stuff is still a really key part of how economies are going to grow. And because of that higher growth, energy demand is also going to be increasing. So you're not just thinking about shifting your existing energy supply and just like replacing some renewable energy with fossil fuel energy with renewable energy. You have to increase your overall energy mix, and that may require some kind of transition consideration so that your growth opportunities and your growth needs actually can also be aligned with your decarbonization needs. And so I think where that it becomes important is, okay, like, if you do have the transition considerations, how do you structure the framework to avoid effectively greenwashing? How do you avoid activities that aren't really related to transition being classified as transition? How do you set the time frame so that we understand what the limit, what the time horizon limits of transition will be? Because yes, okay, maybe you're okay with gas until 2030 or maybe even a little bit later, but maybe not by 2040 or 2050. And you have to consider things like the asset lifespan, right? If we're talking about and the span can be potentially even 20 years for some assets, then you might need to make decisions now, whereas certain other transition activities may have lifespan where you can transition much quicker and get to your net zero by 2050. And I think what's going to be good is, I think, because of just the just more skin in the game in the region, I think we're going to have a lot more input to how transition should be framed and how it should look at the global level.
Thanks for sharing that. I think maybe I'm running out of questions. I think one question that I'm seeing as well is, I think that company is probably a pre-IPO, pre-SPAC company. They're thinking about creating their first ESG report. They're seeing different frameworks out there, GRI, CDP, Hong Kong Exchange. I mean, there are so many emerging. Well, I probably know that you provide a balanced view that it depends for industry and region. What are sort of the frameworks at a minimum that you think these companies should use when considering creating their ESG report, considering what are their material considerations, what to include, what not to include? Is there any pointers from yourselves?
All right, I'll jump in. So basically, for me, part of it, so first up, depends on company size and the scope of operations and what they're doing and the extent to which these issues are actual material risks and problematic for the issuer. So I would say that looking at clearly local regulation is a great way to start in terms of what's required and a minimum standard as to what you need to be compliant and how to represent yourself. What I would always recommend is a genuine approach of identifying which of these issues are important to the company, your stakeholders, and which ones are going to be integrated into the strategic operation of your company. And for me, that's your cheat sheet to get the short list of what to include. So external frameworks can help for how you frame it. So you might GRI for some metrics if you've selected a topic. You might use SASB to help discussion around what could be financially material. And then you might speak to some stakeholders in the chart that Mervyn presented earlier around understanding how you have impacts on broader community and how that could impact your business and where they see the important components for your business. I say genuine in that this chart appears in almost every single large Hong Kong listed company's sustainability report. Some of them are not as good as others and look like they've been created without involvement of senior management or any strategic approach. There was a very memorable one I saw which said that apparent firm prioritize and external communities higher than it prioritizes profit. So I asked the company how they prioritize communities and environment and employees over profit, and they looked at me very confused and like, what are you talking about? And so it's this sort of thing in that it has it actually, because if we step back and say, what are we trying to get with ESG disclosure? What are we trying to look at? We're trying to figure out, has the company strategically engaged with the most material issues that can either be the impact of the company on society or the impact of ESG issues on financial performance? And do they have a strategy integrated into their approach, which is going to mitigate the negatives and help manage maximization of positives where consistent with strategy? And where that's all tied in and present, then that's awesome. Then you've got that's essentially what you're trying to get. You don't want a company to come out with a 600-page CSR report with fantastic pictures of handing out school kids equipment and doing community bingo nights and things like that. The question is, how does this actually relate to your business? What are you doing? And I really like I think it's Alex Edmonds, like the Grow the Pie framing of this, which was to say that think about the multiplier effect that a company can have in terms of having a positive contribution. So if you give away money, the value of that is $1. If you are donating your services to actually have a positive impact or giving cut price products, if you've got a gross profit margin of 50%, then clearly the cost to you of actually delivering that is way greater than 1. So you're able, with the same amount of investment, you're able to have a much bigger effect through your operations. And for me, that type of mindset around positive contribution is a really important one. And around risk mitigation, it's about the board, senior management sitting down and actually saying, where does this fit into our strategy? How is it going to improve resource efficiency? How is it going to improve retention? How is it going to minimize risk? How are we going to maximize outcomes? And how does that fit in our strategic 5-year, 10-year plan? If that hasn't happened, then I would say that it's a public relations exercise that the company's undertaking. It's not a ESG integration and communication exercise. So long-winded answer, but I'd encourage them to go through that strategic process of identifying what matters. There's no right answer here. If the company has a good justification around why they've selected 4 topics that they think they can move the dial on, that's great. And understanding how they arrived at that process can be really valuable for investors. And the final comment is, if we look back at TCFD reporting, so Task Force on Climate-Related Financial Disclosures, they break it up into corporate governance as the governance of sustainability, but then also the strategy component, which is scenario analysis, risks and metrics, and scenario analysis. Then there's metrics and targets. And interestingly, the components within the 4 pillars, it's actually the strategy component which was the most valuable for investors and users of those data. So it's not necessarily the number or the framework. It's what thought process did you go through as a company to actually identify and manage this, and how have you thought about it strategically? Because that tells us as investors that you're genuinely engaged with it, and it allows us to evaluate the quality of your thought process, not just the quality of your bank balance in paying an external agent to write your reports for you.
Now, I'll definitely take a good look at the strategy section of the TCFD reports, and I fully agree with you that generally look at your material risk, and then you look at the various frameworks out there, while of course at a minimum meeting your local standards. Sorry, Mervyn.
Oh, I just wanted to add one thing. It would be good if sometimes companies actually know the data that they've disclosed, because it's like, oh, so why did your carbon emissions half, or intensity half? And it's like, oh, maybe it's because COVID had cut your sales, or maybe it's because of some divestment of a business, or there's a lot of things, right? And it's interesting when you look at it, when you hear an earnings report on financials with a company, they can explain to you every micro detail of why earnings have changed, or like why the margins have shifted and whatnot. But with ESG, we're definitely not there at this point. And so, yeah, like especially with some, with, like, let's say emission numbers, it can be quite volatile for a whole host of reasons. And so having that, like, just a showing of understanding of what you're reporting would be a bit of a holy grail maybe at this stage.
No, great. I think I'll probably ask 2 more questions before I pass it back to Professor Zhang. I mean, one of them is there are many sustainability indices out there. Some companies, obviously, S&P Dow Jones Sustainability Index. There is the FTSE for good. I think there's a developed versus emerging Asia one. I mean, in Asia, which ones are you seeing that people want to get on? What are their strengths and weaknesses? I think, but I might be wrong, I think the S&P one is more focused on developed markets and not yet the emerging market. I mean, again, anything you could share in terms of view without, breaching any rules, I guess, could be a very high-level overview as well.
I can give a very blunt assessment. Okay. For me, I see sustainability indices can be helpful in that, yes, they can provide a guide as to what best in class looks like, but they're also one view of the world and trying to push people towards a specific set of standards and disclosure standards typically that highlight what is required to succeed. And so is it just an ESG score? And if so, what are you achieving? How does that work? Some ESG indexes are just the highest scoring companies that meet certain requirements of industry involvement. Others, like Dow Jones Sustainability Index, has a very comprehensive checklist of the sorts of things that you have to complete. I see them as being helpful around trying to signal commitment to ESG and sustainable operations, especially the Dow Jones Sustainability Index. It can be helpful to help direct and guide what a gold-plated framework for disclosure and checks and balances and systems and structures can look like. For us, we definitely do not use them as a portfolio construction tool. We are not going to be building specific, we wouldn't put it into a thought process or consideration when we're thinking about what what the ESG credentials or performance of an issuer. So on that side, it can be an interesting signal value, but it's not going to determine the extent to which it gets put into our portfolios. So I see it as an interesting one in that they can be helpful, but I wouldn't define excellence by index membership.
Sorry.
Sure.
I was just going to say maybe also kind of there's probably an evolution in the index space as much as there is in the analysis space, because now you're getting low carbon transition indices, Paris aligned indices. It's a whole set of new acronyms for everyone to enjoy now that they've got past ESG, and where the organization, so where the industry is shifting, right? Where like instead of just what is sustainable and what is not, so there's a very different thing when you're saying a company is like net zero aligned versus whether they have good corporate governance, whether or whether they are susceptible to physical climate risk. There's a lot of different things out there, and I think you're seeing indices being shifted and like innovation in indices to capture some of these nuances.
No, perfect. I think I'll do the one last question that I got from the audience, so I'm just reading it out loud. So the green bond market has been getting more traction. There are many providers out there that either certify a green bond, or I'm seeing a lot of second-party opinion provide. I don't think there's a regulation saying whether you could or could not provide an SPO. I mean, again, it's probably similar as with the ratings. How can people, should people rely on these? How should they look for quality in these green certification providers, stamps of approval, basically, or SPOs, so to say?
I'll quickly make some comments here, but for me, when I think about green bonds and the quality of a bond, part of it will depend in the market that it's been issued in and the standards that the bond is trying to hold itself to. So first up, we have to check what the SPO provider is actually rating the bond against. So they're often saying, is it true to label? But the question is that label consistent with what I would consider to be a green bond as an investor? A classic example of this is that in some markets, you need 95% of proceeds to go towards green initiatives. In others, you need 50%. And so you have a very big gap in terms of what the bond is going to be doing or committing to do and what you're checking it against. The other components here are that the quality of disclosure and characteristics of the issuer can increase or decrease the need for a second party opinion or the reliance on that second party opinion. The other challenge is who is providing the second party opinions. The latest Climate Bonds Initiative report, which was talking about this, was highlighting that in certain markets in the region there is a massive fragmentation of SPO providers, and so that can again raise the question mark around to what standards are they doing this? To what level of expertise do they have? Do they have audit expertise first up? Then do they have environmental expertise in order to validate the project? For me, one big gap that I see within green bonds is actually after the bond has been issued, the 12-month later health check to say, have you actually done what you said you would do? And for me, that's the biggest gap. I think that there's the percentage of issuers that provide that type of analysis is much lower than that verify the initial framework and consistency and standards of the bond. So I definitely think that one issue is fragmentation of green bond standards, and this goes to Mervin's point on the traffic lights and different classifications of what is green and appropriateness of that classification for different markets given their own transition trajectories. So there can be different interpretations, and we need to be clear on that. And then the second is, what's the quality of the SPO provider, and do they have the experience to verify that? And then are they verifying everything that you want to know, and are we doing the follow-up in order to evaluate whether it genuinely is sustainable? So that they're typically the layers that we go through, and there's a combination of third-party work, and then there's also the in-house assessment of the individual instruments.
No, perfect. I mean, this was hugely insightful to me and entertaining as well to talk with three experts here, two from the industry and one academic. It was great. I hope the audience liked it too. I'm handing it back to Professor Zhang. I really thanks Gabe and Merv and Dr. Han for taking time out of your busy schedules to share the very nuanced view. I thought it was very useful. So
Okay, great, great. Time flies. I cannot believe it's almost the end of our seminar. So actually today's topic is very relevant to me as well. So I'm doing research on ESG. I'm also puzzled about different data sources we use. So which one is more reliable, which one is more accurate. So for me, currently I have a project try to use NLP to create my own ESG rating or the index. So it's a tough job, but we are doing that right now. So anyway, so actually I myself learned a lot from all three speakers, my colleagues and our industry friends. I would like to thank all of you for your wonderful talk on ESG rating and optimization. So we also thank Professor Ni for your hosting our guest and moderating the discussion. So lastly, I would like to thank our collaborating organization, HKIRA, and our supporting organization, Australia CPA and HK Institute of CPA. Also, lastly, I would like to thank Carol. She is tremendous help for organizing the event and the seminar. So thank you all. I think it's a very successful and wonderful event. So I would like to remind you, this is not our last event. We will continue to host the CSF past seminar, right? So next one will be in May. So all of you are very welcome to join us. So by the same time, if you have any questions or you have any thoughts and or you want to share with us, please let us know. So finally, so I hope you stay safe during this difficult time. So this concludes our seminar. So I look forward to see you all soon again. Okay, take care.
thank you.
Thank you.